Hello, folks. Brandon Chapman with you today. It's Monday, August 19th. It's a TheoTrade video. And boy, today, high beta gets squeezed as the vol markets scream caution. Which do you believe? Do you follow the vol markets or do you say, hey, I've got to jump in? The reality is you can do both. So we'll talk about that. As we look at the S&P, we're up nearly 1% today. You look at the three sectors that are outperforming: technology, cyclicals, and then communications. And this is really an indication of the high beta squeeze that's going on, coupled with the short squeeze. We'll look at high short interest stocks north of 20% and the impact they're seeing on the market, or the impact they're seeing today, and the squeeze higher we're seeing in those names. But let's dig in. So S&P up 1%. Now, if we look at the last little bit, look, you get a sell-off like we've seen, okay? It is normal. Sorry, wrong one. It is normal. This is our low to high right here. It's normal to see a 1/3 to 1/2%, 2/3 retracement off of this sell-off. If I take the entire sell-off from peak to trough, it's normal to test 61%. We've gone beyond those levels. We broke the 61% here of this sell-off. We take the entirety of the sell-off. We broke that last Thursday, and today we're accelerating higher. Now, earlier in the session, we had a dynamic where the S&P had 5 or 6 sectors. It was down here. We had probably 6 sectors outperforming the S&P 500 out of 11, which is significant. We had a lot of breadth to this rally. Everything's going up today, but on a relative performance basis, energy, that was the best performer earlier in the session, faded from the resistance, which is interesting, right? Again, this kind of inflationary scenario, maybe even stagflationary scenario. As the dollar, if we look at $DXY, the dollar index is getting crushed today, and yet gold is off very little. So we look at the real value of the dollar decreasing very minimally as gold's up down 0.61%, in fact, increasing, whereas the dollar on a relative basis is weakening significantly, particularly against the euro. But even we saw indications of yen strength. It moderated as the session wore on and kind of helped the market lift. But again, are we breaking out of this bear flag formation? Are we looking for the yen to test 140 against the dollar? Okay, this is a warning sign right here. If the yen is going to strengthen, but it was the moderation in yen selling that helped kind of support things, but it actually began to see more heaviness or top heaviness with very few sectors, namely technology and cyclicals. Now, what's so significant about technology and cyclicals? Well, you could say technology, oh yeah, the monsters, these monsters of tech, these magnificent seven, companies like Apple, for example. Well, Apple was actually off on the session. What about NVIDIA? NVIDIA saw a very strong move in 4.3% today. We look at Intel, right? In fact, look down here at the movers: AMD, Tesla, Intel. What is special about these companies? Well, this gets back to our theme of high beta. So I'm going to show you something here. So if we go to the high beta ETF, what you'll see, the breakdown of its portfolio: technology is 46%, consumer discretionary 17%. And so when I see high beta really moving and outperforming in particular low beta, so if we look at SPHB here, high beta is up 1.36%, significantly outperforming the SPY today. If we look at low beta names, these are the 100 lowest beta names, only up about 0.5%. We're seeing a rotation towards high beta. And again, I kind of look at this ratio, SPHB plus SPLV. When this ratio is going up, it's an indication of a short squeeze. And so as we look at the composition, so here is the sector breakdown, but what about the individual? We got market cap. What about the individual companies? Well, look at this: NVIDIA, AMD, right? Keep coming down here. Tesla. If we expand this view all, and we look at the technology part of it, right? You got Broadcom, you got Lam Research. You just keep coming down here. CrowdStrike, you got JBL. Got a bunch of these names. Intuit, Autodesk, Adobe. Again, you can go through these and you'll find all of these top performers as part of these top holdings in the technology space. As you come down, you'll see consumer discretionary, Tesla, Caesars, right? CCL, RCL, NVIDIA. We got some home builders in here as well, MGM. But you're seeing performance in a lot of these travel stock names, right? If we get to see come down here to industrials, we got American Airlines, right? We got the airlines companies in there as well. So you notice what's going on here. Again, the high beta names are seeing some movement right now, getting squeezed to the upside. And again, this list just really just demonstrates that, as the top names, with the exception of McDonald's, which is up 3% today, big move here. Again, but this is more of a trading down effect. But again, Tesla, NVIDIA, AMD are all on the top of the list, all coming off our lows right now. Now, as we look at this, this is usually a very temporary phenomenon, but it can go for a while, right? I mean, this may just be the beginning. We may quickly retest prior highs on the SPY. We may break out again. But again, we've just broken through very key levels based on large 1 million share prints. We've just kind of blown through them. It looks like we readily want to retest our prior highs. Now, the question is, of retesting prior highs, only about a 1% move off of our current level. Well, for looking forward, maybe from weeks to maybe months, what's the market have in store? Well, we start to look at the volatility market. So let's take a look at the VIX. The rally we've seen has come at a price, right? One of the catalysts that have helped jettison the market higher like this has certainly been VIX selling. We shot up quickly to 65 literally within a couple of days, and one day went from closing at around 24 to 65, and then almost round tripped intraday to 38. And we've seen significant VIX selling over the course of the last 2 weeks. This has helped propel the market higher. It's helped calm the storm. We sell vol and we buy stocks. Well, guess what? This comes at a price in that there is a term structure to volatility, VIX3M. Well, if I look at where the 3-month VIX is today, the VIX is at 14.65. The 3-month VIX is basically 3% higher. So as we do a ratio of the two plus VIX, what you'll see is that we went above 1.2, this left-hand scale over here, we went above 1.2 last Friday. What that means is the 3-month VIX is 20% higher than the 30-day VIX. So down here, when we go below 1, which was on August 5th, it's time to maybe look at nibbling on some stuff. Unfortunately, a lot of brokers, you couldn't trade. The spreads were wide. You could have maybe rolled, if you had some hedges on, you could have rolled your hedges, and that opened up the upside here, and you got a nice swing over the last couple of weeks, right? Week and a half, 2 weeks. But what's happened is we've reached another relative extreme. We look at skew. Skew on Friday ticked lower to 142. We'll see if skew goes higher today or lower, but we're still very, very elevated by historic standards. Anything north of 130, which we've been there all year long, says the downside risks are preeminent. Okay. So what happens is when you have high skew and low volatility, the market's reaction is to have a higher frequency of small up days, but you're building the case for a bigger sell-off. And the fact of the matter is, the signals that we're seeing right now in the S&P 500 by using the VIX, the 3-month to 1-month VIX ratio, and what's going on in the skew would suggest we've got maybe 5 to 10% downside off our present level in the next maybe several weeks. Could happen tomorrow, could happen a week, could happen 3 weeks, may not happen at all. But what's happening right now is what you're seeing is institutions are hedging at a very high level, and they're forecasting significantly higher view volatility out in the next several weeks as we roll away from that 30-day time frame, as we're starting to see that 30-month window really starting to play out in the market. Now, this similar thing happened back here on June 18th, right? Market had a last gasp, and then we rolled over. But the idea is the downside risks are more significant than the near-term upside opportunity. So again, hedging your risk makes sense. With the lower VIX, you can buy a put. You could sell a call vertical and finance it. Last Friday, during my session on TheoTrade, we walked through how to do it in a version of an atomic hedge where you're selling call verticals and buying puts. We also last week walked through how to manage a hedging strategy from the point back here on June 18th where we introduced it to rolling the put on the 5th to then rolling it up on Friday. I think it was around a shoot, what level was it? Around 54.50, around that 30 delta. And again, in the sell off, you booked a couple thousand off of that hedge on a $100,000 portfolio, but then you roll it up, you expend some cash, you're still up $1,000, and you have a hedge in case the market sells off here in the near term, and it's paid for. And we're not taking any upside. Well, on Friday, we walked through a new hedge, if you didn't have one on, where we sold call spreads and bought puts. Point being is that right now it's reasonable to hedge, it's reasonable to take profits, but it's also reasonable to be long the market on a limited basis. And there are defined risk trades out there. Now, one of the areas we're seeing strength right now, we talked about high beta, and I mentioned that SPHB is my short squeeze indicator. So during my session today, I walked through how to search for, and we talked about my high short interest watch list. This is one I put together today for stocks that have greater than 20% short interest. Now, notice something, right? These are all stocks. This is their performance today. A Bio up 21%. We look at ALT, right? Up 16%. ALLO up 15%. TGTX up 14% going to the close. CRNC. Notice what's going on here. Look at the industry. The top 4 performers there: biotechnology, a couple about pharmaceutical, biotechnology. All of these names right now, virtually all of them, the best performers today were in the biotechnology space. Many of these companies are terrible companies fundamentally, but they share one thing in common. They have greater than 20% of their float is shorted. And when you start to see traders kind of run for the door, shorts cover, you get these big moves like this. You don't need news. All you need is someone to begin to cover, and then it creates that domino effect, the positive feedback, and you start to incorporate some positive or bullish unusual option activity like what happened in TGTX, and you get a 14% move. My scan today, these are some, and this is just targeting the high short interest watch list. I've crossed it with weekly, so it's going to eliminate a lot of these that don't have weekly options, but you'll see TGTX, Upstart Holdings, we got Novavax, Plug Power, Peloton. Again, we're seeing the short squeeze in these in particular, and you see some of the performance of these options just today from Friday's close: 390%, 258%, 207%, 200%. This is just from Friday's close to today. And many of these stocks, like for example, TGTX, it was up a little bit. Most of the action, most of the positive move happened intraday today. And again, you see that coincidence of option activity and the high short interest coming together, where we see a gamma squeeze to a short squeeze, and we see that positive feed loop continue to drive these stocks higher. Sava is one that's had a very significant short squeeze in recent weeks, had a pretty significant sell-off, lost almost 50% of its value. We're seeing that re-engage again. Sometimes you end up retesting prior highs. So watch these stocks. Upstart usually see a significant option activity during these squeezes. These are some we talked about here. It took a little while, sold, and then rallied again. But these short squeezes can make big moves. And as you look at the option volatility in these names, let's look 32 days out in Upstart Holdings. But notice 78.3, 78.8, dips a little there, 79. The volatility is rising on the calls as you move out of the money. This allows you to speculate. You can buy a lower strike and sell a higher strike. You could buy a 40.50 and sell a 42 or 42.5. 2-point spread's going to cost you about 80 cents. And you're basically buying at the money, right? Break even comes before 41.50. And again, all we need is get a little bit of break here. You're done. You're out of the trade. And so the positive skew that we're seeing in many of these high short interest names, where basically those that are short are buying calls and selling puts. They're driving down the put volatility, driving up the call vol. And this allows you to create these bullish spreads for relatively cheap, playing the squeeze. TGTX, a little bit less so. It's kind of just all over the map here as spreads are a little bit wider. There's much less liquidity in these names. But anyway, the point is you can see a lot of times some positive vol skew in these names and helps create very cheap upside call spreads. And if we continue to see breadth to this, you can see XBI really exploding today. We could see a continuation in products like XBI, IBB, for example, 32 days out. Again, we've already seen a big move, But again, you can kind of create a little bit of an upside spread in here. Again, the vol skew starts to get a little bit better as we get out towards 104, 106. 104, 106 is right up here. Still very plausible in 30 days if we continue to see the short squeeze that we're exhibiting right now. But again, this list here sees a lot of biotechnology companies, and you can see some down here that are underperforming. B. Riley has a lot of exposure. It's the reason why these stocks are going down, right, to the commercial real estate market. MPW, obviously, we're exposure to medical. It's a medical REIT, buildings, right, for doctors, etc. But right now, it's really the biotechnology space. You may start to see rotation to other parts of the market. But again, once you know how to find it, right? Once you know how to search for it, again, there's lots of ways. Finviz, other places you can search for it. I've got my list here. But the idea is once you know where to look, you can continue to isolate those companies and see what's happening on the open. And you'll see a lot of times these squeezes start early and they just continue to ramp up throughout the course of the trading day. Obviously, a 350 stock, hard to play options on, but still, that is a 21% move. If you saw the breakout on the open, you understood what's moving by virtue of high short interest, short squeezes. You have a chance to kind of ride this to the high. So we have this juxtaposition here. We're seeing a rotation towards high beta. We're seeing a lack of real outperformance, breadth to the outperformance. We're really just seeing technology and cyclicals lead the way. That's if by virtue of the short squeeze, the high beta squeeze that we're seeing right now. Again, it's hard to know when those things will end. It's okay to ride them, but at the back end, it's also reasonable to begin to hedge in case the downside to the market more generally starts to gain some traction. So again, this is a point where we just got to be a little cautious at jumping in heavily near highs, but it's all right to take defined risk type trades and look for those opportunities like we're just talked about here by virtue of using call spreads, etc., playing that upside where the skew's in your favor, and then hedging the bigger parts of your portfolio like your long stock holdings. Now, if your long stock holdings are likely dominated by biotech names, realize that, hey, we could readily see a big sell-off like we saw, for example, on the 2nd and the 5th. So again, this is an area that's hard to hedge. The betas are understated for those names. The volatility is 4, 5, 6 times higher than the VIX. These names come at a price. So doing it on a defined risk basis may not be a bad way to go, but hedging the bigger picture, hedging the bigger parts of your stock portfolio that are more representative of the S&P, looking for hot opportunities amongst the high beta names. Again, we kind of talked about the top performers here. Certainly is reasonable. The biggest allocators in this one. So again, bringing it together, high beta, high short interest, looking for unusual option activity in those names is a combination. If the market continues to squeeze, that should work in this environment. Alternatively, the volatility markets are screaming caution. So look at hedging the bigger parts of your equity portfolio that are aligned with the S&P or other indices, because right now there's a significant amount of hedging activity and volatility expectations to the tune of maybe a 5 to 10% correction in the market in the coming weeks. So be prepared for that downside risk to remain. Of course, we've got Powell today at Jackson Hole. Normally they'll articulate some degree of policy. We got a September meeting coming up. We're expecting rate cuts. So again, he could throw a wild card out there. So don't be surprised if maybe we finish lower by next Monday. Anyway, have a